Welcome back. As promised, another conversation with an expert Bloomberg Intelligence analyst. This time we're joined by Paul Gulberg. He studies the Canadian banks at Bloomberg Intelligence and joins us right now. Thank you for coming in, Paul. And it's good to have you in person here as well.
Absolutely. Thank you, Paul.
Both Paul and Gillian are based in New York, but they come to Toronto every now and again. We're delighted to have them. You've said in some recent work you've done that the first quarter earnings were healthy. You see a healthy first half of earnings for the Canadian banks. You think the second half could be solid as well, but the trajectories among the different banks are different. Why don't we start there?
Well, so the first half was pretty good. I mean, the interest incomes held up much better than expected because of the interest margins held up reasonably well. Banks did start increasing their provisions in the second fiscal quarter because of all the uncertainty in the markets. Most of these provisions you do see are for commercial banks, for commercial loans, because of the tariff uncertainty. In terms of the divergence, some banks probably reserving a little bit more ahead. We've seen it from RBC, a little bit of a heavier reserve. CIBC, a lot of people saw a little bit lighter reserve, for example, but that was just the second quarter. If you add up the first half, they were all reasonably well provisioned.
Was it a surprise to you to see provisions rise as they did?
No, absolutely not. After what happened in April and all the uncertainties surrounding it, it was a given. And all the banks actually run the scenarios for those provisions because there's the model provisions for the loans that are actually performing.
Right.
So they build up reserves in anticipation of some sort of uncertainty. And obviously, with all the uncertainty in the markets, with all the volatility we're seeing in the capital markets, it's a kind of a given that they have to.
Is it too early to forecast whether they will return many of those provisions back into profit in quarters ahead?
Oh, yeah, I think, well, how many quarters ahead would you like me to forecast? Because I would say the second half, the next 2 quarters, I don't think so, even though if we'll look at what Mark Carney and President Trump talked about yesterday and the potential for 30 days, even if we do hit the 30 days and it's going to be before the end of the fiscal third quarter, I don't think they'll jump in and start releasing reserves right away in the fourth quarter. They might see how things are actually shaking out. So 2026 is going to be potential for the year to be of less provisions.
How uncertain is the loan growth environment right now? What does loan demand look like among their customers?
Loan demand is fairly light. We've obviously seen it on the consumer side because of the uncertainty. The mortgage market has been sluggish in the first 3 months of the year, but in April and May, things gotten a little bit better. But we do see like credit card balances are getting hit and things like that. So people are mindful of what they're spending on because of the uncertainty. And on the commercial side, definitely people don't want to make investment decisions or go public and things like that, just because they don't know how things are going to shake out.
Right. That's the tariff uncertainty has been a real source of lack of confidence among the commercial side. What about capital markets? We saw strong capital markets performance at most of these banks in the first quarter. Is that a fair generalization?
That is definitely a fair assessment. A lot of it came from a trading volatility.
Right.
April was a very crazy month. Even December was very unusual because it still went into fiscal first quarter. It was very unusual November, December because of the elections in the U.S. So there was more uncertainty and some of the euphoria that kind of went away in February when tariffs were announced. So a ton of volatility helps the capital markets, a lot of trading on the equity side. Obviously, it did pull back some of the M&A activity. Some of it has been delayed, but on balance, the capital markets held up better.
It's difficult for you as an analyst to make predictions on capital markets activity in the future. Is that fair?
Well, I mean, it's always the case, and especially on the trading side, because you kind of think of the macroeconomic environment and what companies and people are doing, but you cannot predict really the spikes that happen within the quarters.
Okay, we're out of time, but what might investors expect with respect to dividend increases and share buybacks from the banks in the second half?
So the dividend increases were up about 4% for the banks that increased in the middle of the year. The capital ratios are well above the minimums, and they actually announced the buybacks. So even though the dividends are at the high end of the ratios of 40 to 50% ratios that they typically pay out, I think I can still increase the dividend, especially if we do get some clarity in terms of the tariff